Hello everyone, welcome back to another video of our Chapter 10 exercise series from our Managerial Accounting course, ACCT 428. In this video, we're going to be looking at exercise 10-4A. So let's read the question together. It says, the Dean of the School of Fine Arts is trying to decide whether to purchase a copy machine to place in the lobby of the building. The machine would add to student convenience, but the dean feels compelled to earn an 8% return on the investment of funds. Estimates of cash inflows from copy machines that have been placed in other university buildings indicates that the copy machine would probably produce incremental cash inflows of approximately $25,000 per year. The machine is expected to have a 3-year useful life with a 0 salvage value. So what's required here in this scenario? A, we need to use present value appendix table 1 to determine the maximum amount of cash the dean should be willing to pay for a copy machine. Okay? So regardless of the wording of this question, we simply can bring it back to the concept of present value. So the machine is expected to generate $25,000 per year, okay, over 3 years. So based on that, we need to discount these cash inflows to see how much they are worth today. What's the maximum amount that we should be willing, or the dean should be willing to pay today in order to generate this much cash each year over 3 years. As I have always recommended you, if you remember in the lecture, we talked about timelines. I prefer to use timelines with these kinds of questions. It makes your life a lot easier. So let's begin with that. For part A, we're going to sketch a timeline to help us visualize the cash flows and calculate them. Okay, so basically this is time 0, time 1, or at the end of year 1, the end of year 2, and this is the end of year 3. Okay, over those 3 years, we expect a cash inflow of $25,000 each year. So I'm going to write that down. And what we are trying to calculate is how much should be the cash outflow that we should be willing to pay today for those amounts, right? And the interest rate, which is R, let me put it here at the top, equals, was given to us here in the question, yes, right here, 8%, right? So this is the discount rate that we should be using. Okay. However, N is going to be variable. Remember, here in the first requirement, they're asking you specifically to use table 1. So we cannot, even though this is an annuity, for part A, we cannot be using the present value interest factors of annuity, which is in table 2. We're going to have to discount each of these one by one, right? So what I like to do is just sketch my timeline and then do this. So this is for year 1, this is for the 2nd year, and this is for the 3rd year. Okay, and I'm going to write down the discount factor for each of those. Where am I going to get those? From table 1, just like the question asked for. So let's go to table 1, zoom in right here, sorry. We're going to be looking at this specific column for 8%, and then these are the interest factors that we're going to be using for 1 year, 2 years, and 3 years. Okay, I'll write them down in my calculator to make it easier to copy. So the first one, 0.925926. Go back to the question, write that down here. 0.925926 for for the second year, 0.857339, 0.857339, and the last one is 0.979, sorry, well, I made a mistake here, 0.793832. Copy that down, 0.793832. Okay? Now, each of these factors are just going to be multiplied by the 25,000, which is the cash or the expected cash inflow, right? So, beginning with the first year, 25,000 on my calculator multiplied by 0.925926. And again, just to remind you, the question also is asking for us to round the figures to 2 decimal points. So that's what we're going to do. So the amount here for the cash flow expected in the first year, the present value of that is going to be 23148.15. So that's $23,000, $148.15. Okay. We'll do the same for the second one, $25,000 multiplied by point. Of course, this time we're going to be using this discount factor. So 0.857339, and the present value is going to be 21,433.4. I'm getting 475, so I'm going to round that up to 0.48 because the question wants 2 decimal places only. And for the third year, again, $25,000 multiplied by 0.793832, and that's going to be 19,845.80. Okay. Now, finally, of course, we don't want these spread out like this. We want to bring them to a single present value, right? Because the dean is not going to be paying multiple times. Of course, there's going to be only one cash outflow, which is, as I said, this is the amount here that we're looking for. So I'm going to add these together. I already have the last number on my calculator, so I'm just going to add 21,433.48 plus 23,148.15. Okay, and that is giving me a present value of 64,427.43. Okay, which is the present value here, present value or the cash outflow, 64,427.43. What does this number represent? It represents the maximum amount that the dean should pay in order to buy this copy machine. Okay, so if he finds that the copy machine is sold for a larger amount or a greater amount than this, he should not buy it. If it was sold, for example, for 62,000 or 63,000, 60,000, any amount that is less than this amount, then maybe that investment would be worthwhile. Okay, so that is part A. A little bit tedious, but this is the point, I think, of this exercise, to show you how easier it is to use annuities. Okay, so let's see the second requirement, B. use present value appendix table 2 this time, which is the table that is dedicated for annuities, to determine the maximum amount of cash the dean should be willing to pay for a copy machine. Okay? Notice how easier it's going to be for us to do this part now. So B, okay, the present value, let me just quickly remind you of the formula. Present value of annuity is going to equal the payment multiplied by the present value interest factor of annuity. In this scenario, we have N equals 3, and the required rate of return is 8%. So this is what we're going to be looking for in the table. All right? So let's find the interest factor of annuity first. We'll go to table 2, present value of an annuity, 3 years, okay, and 8%. This is the interest factor. I'm going to copy it on my calculator so I don't forget. 2.577097. Okay, go back to our question and now substitute in the formula. The payment is the 25,000, okay, which is going to be the regular payment that we expect to receive at the end of each year. $25,000 multiplied by 2.577097. Okay, I already have the interest factor of annuity in my calculator, so I'm just going to multiply that by 25,000. And the amount I get is 64,427.425, so I'm going to round that up to 43 cents. Okay. Now notice how this present value of annuity is identical to what we've calculated in the first step. Okay? And this is, as I said, the point of this exercise. Notice how easier it was for us to do it this way instead of discounting each amount individually, right? And this is the point of table 2. This is the point of annuity. There are certain conditions. If they apply, we can use the annuity table to make our life easier instead of discounting each cash flow. Okay? Those conditions are: the required rate of return is fixed, the payment is fixed, so it's the same, so it's a regular payment, okay, and the time intervals are fixed. So we're receiving 25,000 at the end of each year for every year throughout the duration or the expected life of that investment. If these three conditions are met, then you can feel free to use table 2 and use the formula of annuity instead of discounting each cash flow individually. Okay, I hope this point is clear. It's very important because many students find it difficult to relate these two. Any annuity, you could use table 1 to calculate, so you can discount each cash flow individually, but not any present value calculation can be calculated using table 2 or using the annuity. The annuity is just a special case to make your calculation easier. Okay? If the question meets the three conditions that we just mentioned, the fixed required rate of return, the fixed amount, and the fixed time intervals, then you can use the annuity calculation. All right, so let's now move on to the last requirement, C. Explain the consistency or lack of consistency in the answers to requirement A and B. And of course, we don't have a lack of consistency. We do have consistency because we got the same answer exactly using both methods, right? Why that is? It's because of the reason I just explained. So we can put this in words. Okay. We could say something like the present values are the same because the present value factor of table 2 is simply the sum of the three single values, let's call them, or single factors from table 1. And we are basically calculating the same thing. Okay? Let me show you what do we mean by this. We mean that these three factors, if I total them or calculate their sum, they should equal this annuity factor. Okay? Let's do that and prove it. So on my calculator, and on yours if you want to give it a try as well, calculate 0.925926 plus 0.857339 plus 0.793832 equals, and the number that I have is 2.577097, which is the same amount that we used right here. All right. I hope everything is clear, and I hope that you found this walkthrough of this exercise useful to you. If you have any questions, please feel free to drop them down in the comments. This is how you solve any exercise that is similar to exercise 10-4A. Until I see you in the next exercise tutorial, take care.